Cheers.
Cheers, my man. Cheers to the
Cheers.
episode that's been a long time coming.
I'm gonna preface this whole thing with this, and I told you I was gonna probably do something like this. My wife goes, "What are y'all gonna talk about?" And I said, "I don't know." She goes, "What is it called?" And I said, "I don't want to tell you." She goes, "Why not?" I go, "Because it's gonna make me sound like a douchebag. Not that the title's douchebag. The fact that you're interviewing me is the douchebag part of it. The hunt for incredible." And she was like, "Oh, you're incredible, huh?" And I was like, "No." And I feel like I'm on the hunt as well. So I'm just putting that out there. I should be interviewing you.
Oh, yeah, right.
Maybe that
Oh, wait,
is,
wait. Did you think you were the
I
incredible?
thought I was incredible.
Nobody's born incredible. People who do incredible things simply took the right steps. This is our journey. This is the hunt for incredible.
We'll kick off the show. I've got my good friend Elliott Goudge here. So, what is it that you do in oil and gas? Like a brief summary, and then we can dive into your story on how you
Yeah,
got from entering the space into where you are
yeah.
now.
Yeah, so we're an exploration and production company, EMP for short, which means we drill for oil. We're not really wildcatters, so the explorations, it's more probably the production side than it is the exploration side, in that we're not out trying to find new plays, or the old wildcatters go, use a bunch of obscure geology to go find a conventional or trap type play. What we do is we go into unconventional, which is what you hear most of, which is the fracking and all those, that kind of methodology, and we go into proven known plays, and we basically look to acquire through several different means, and then drill wells. We sort of, our thesis, and we set our company up to just be very small, nimble for that industry, but then from a technical basis, operate at a really high level.
Okay, so you raised and deployed $80 million.
Yeah. On like this iteration of our company, we've deployed, well, on a gross basis. On a gross basis, we've probably deployed close to $100 million, on a gross basis. But on a net basis, it's 100 plus, actually, probably. But it's a capital intensive business. It's not any dissimilar to any other business from the perspective of, like, I've told people this before, it's a higher risk, higher reward business model. But like when you start to net everything down, which is where you can have big wins at times, like the return metrics aren't that different from most any other business. I would actually venture to say it's almost harder for you to get the kind of wild, crazy returns than you would like in tech. Real estate's pretty steady, as you know, or steadier, but you just deploy a lot of dollars because of the nature of the business, because you're drilling these obscenely expensive wells. And that's onshore. You go offshore, it even gets crazier. So
Yeah.
yeah, we've deployed a lot of dollars, but I look at it as more industry driven than it is like any particular person driven, right? It's not like I've deployed a lot of dollars just because I've scaled something to just a monstrous size, right? In fact, we're pretty small in the grand scheme of the energy space, if you will. But yeah, we've deployed a decent amount, and
So I see that humility sneaking out again. 100 mil, regardless of the industry, to be trusted with that much capital, whether it's a normal size or not, is pretty significant. So yeah, so to kick off your story, would you mind diving in?
yeah. So I got into oil and gas in a really, really weird fashion. I'm not a technical by any means. I'm not an engineer or geologist. I'm not a finance guy either. Right when I was graduating school, I got introduced to a guy who runs a very large midstream. And midstream is, you have upstream, midstream, downstream, which is pipelines and basically moving oil from wellhead or wherever it's coming from to the market. And he ran a very large midstream. I met him. Had no aspirations to get into oil and gas. He was a very wealthy individual who'd done very well, and I worked for him personally. How I worked for him personally is a very long story, but I basically asked him for a job because he seemed very interesting. And at the time, I still had about 6 months left of school. I was waiting tables and doing a bunch of other stuff and playing music, all the stuff I used to do with your brother. And so I wanted to stop waiting tables, so I met him and basically asked for a job, and he said, "Yeah, why don't you work for me personally. He had a bunch of ranches and all kinds of stuff. And while working for him, he was wanting to buy minerals, which is basically buying real estate underground. And it's whenever you are producing oil and gas, you pay the minerals, the mineral owner, and basically a royalty. And so it's a very lucrative, very well-known business model. It's not too dissimilar from real estate, right? And so he was wanting to buy minerals, and so I started learning the industry that way. And then through that, we basically started a very small kind of oil and gas company where he funded deals that I put together. And that's how I got into it. And I worked for him for 7 years. And he's to this day, he's a very well-known, very stout oil and gas guy who runs, like I said, a monstrous public midstream company. And so learned a lot from him, got to work for him personally. He funded everything. And so I got to kind of learn all aspects of the business because it was just me. And a lot of what we were doing was non-operated stuff, meaning we weren't drilling wells ourselves, but we were putting together deals and either selling them or putting together deals and selling pieces and owning pieces of them, whatever it might be. I did that for about 7, 8 years, running everything for him personally, and then wanted to go start an operations company. And so I found an engineer and a geologist that I knew, and I went to him and said, "Hey, I want to go start a operations company. I've kind of put all this stuff together." And he said, "Great, I'll seed fund you." And then he seed funded us, and that launched into getting private equity backed and all that kind of stuff. And then yeah, so that's how I got into it.
Dude, that's sick. So was it effectively his investment was that snowball for private equity to come in?
Yeah, it was kind of interesting. Speaking of success and failures, so our original idea was that we wanted to go raise like a 30 to $50 million fund from private individuals, effectively private equity, and we would use that to kind of launch off. And some other stuff I'd done with him was private equity related. So I knew a bunch of people in the space on the private equity side. Anything I'd done with private equity was kind of with him. And so I didn't really want to do that initially. So we went out and we probably spent 6 to 8 months trying to raise this fund. It was funny. We had a long list of people who were interested. Nobody was doing anything. They were all like, "This sounds great. You guys sound great. Yeah, let us know if you get someone else to actually do it." I mean, that was essentially a failure. And a lot of them were kind of the San Antonio wealthy group of people that do deals around here. It's a hard business to kind of fully understand. And like I said, it's very capital intensive. So going and raising $500,000 doesn't move the needle at all, right? So you're having to take things in like $3 to $5 million chunks. And that's a lot for someone to go invest in a couple, young dummies. So
How did you identify the private equity that you would actually reach out to? Is it just like Googling and seeing private equity that invests in those types of deals?
Well, like I said, so we had a couple of people that I'd worked with in the past. Well, then we went and met with a guy who's become somewhat of a mentor. I'm actually having dinner with him this week, who has built several oil and gas companies up in Midland. Who the guy that seed funded us, who I worked for, introduced us to. We went and met with him. He was the first guy that we had met with that fully got our model because he'd built 5 companies, and he basically is retired, but he still does a lot of stuff. And we went up there and we pitched to him, and he was the first guy right out of the gate. You knew he got what we were trying to do. And he looked at us and he goes, "You guys are young. Don't worry about private equity. There are a lot of horror stories, and most of them are all true. And I can, and by the way, I can attest they are true. But he was like, "But you guys are smart. You'll figure it out. You need a lot of capital. Stop going to all these people and hoping someone's going to give you $1 million. It's not going to get you anywhere anyways. Go to private equity. It'll take you a while, probably through your career, to kind of really chip away at it because of the way those deals are structured. But go to them, and that's the way to do it." And then he called about a week later and he said, "I've got a group that I'm invested in. Would you take a meeting with them?" And I was like, "Yeah." And so we met with that private equity. He was in the room along with several other people. We pitched him, and at the end of the private equity, they said they want to give us a $50 million commitment. And we were like, "Oh, why don't we?" Like, duh, we should have just started with this. And so then we kind of took a step back and we said, and like I said, I had all these people that I called on private equity before, and we basically said, "Hey, if we're going to go the private equity route, like, let's go talk to a lot of private equities before we just. So we actually ended up not going with that group originally. We went with another group, but we went and pitched to probably 15 different private equities, and we had several term sheets, and then yeah, picked a group, and that was the first iteration we did. And then we got caught in the kind of 2020 mess. We ended up getting merged with another company, and that company ended up selling, and it was a whole thing. And then the iteration we're on now was a year after COVID. 2021 is when I spent that year with you a lot, jobless, and then trying to figure out what to do next, and found an asset and worked it really hard and was able to get rebacked by a different private equity.
So that first iteration, what did you take into the private equity, into those conversations to show credibility in what you were doing?
Yeah, I had two really, really bright technical guys, who came from like a strong company pedigree, meaning they both came from a company that's very known for being really, really smart technically. So I think that was a big deal, is to have the right kind of team or line of sight to the right team. And so we had that. I think we had a pretty good strategy. One thing I've learned is, like, who's the boxer that said everybody's got a plan until you get punched in the mouth?
Was that
Is
Tyson?
that Tyson? Great quote. It applies 100% to any startup guy will tell you this, any entrepreneur will tell you this, right? So we had a really good plan and good strategy. We for sure, it pivots and it jukes and jive, and moment you get into it, you're trying to figure out how to create value in whatever way you can. But I think we had a pretty good strategy. And then candidly, uh, the timing. I mean, there's a lot of components to having any kind of success in anything you're doing. But one of them for sure in oil and gas is timing. I mean, and anybody who tells you that's not the truth is just wrong. I mean, timing is, it's one of the reasons that oil and gas is always considered to be such a risky, volatile business, is because timing can always play a big part in it. Now there's ways to mitigate those risks, but it still plays a very big part in it. And we were in a time where, private equity was wanting to put capital to work in the energy space, and we were there wanting to put capital to work, and we had a good team. So
What was your process to finding the private equity to pitch to?
mainly just contacts that I had previously. And then, it's just knowing people in the industry. It's a small industry, so much smaller than like real estate or any of these others, because oil and gas only really exists in certain parts of the US, right? Like real estate's everywhere.
Right.
Oil and gas is not everywhere. Some places it's prolific, some places it's not. And so inherently that just makes it a much smaller industry. And then on top of that, because of the way, like I said, real estate's everywhere, you can go into any town and you can play a real estate game in some form or fashion. It shrinks it even more in that you have like prolific areas where oil and gas is actually being produced. And then you have a couple of towns that like actually host, the business leaders. And it's, Houston, Dallas, Denver. It's just a smaller industry. And so, yeah, through connections is really the way that we kind of found private equities. And we did a lot of vetting and spent a lot of time, calling and, talking to other um, private equity backed groups that might have been backed by these companies to see how they felt about them and stuff like that. So,
Did having those warm connections pretty dramatically improve your odds of being able to raise capital from them, or are they pretty black and white in terms of the numbers and it doesn't matter who you get connected by?
no, connections for sure matter. Um, for sure matter. In fact, I would argue that one of the reasons that we got so much interest right out of the gate was because who seed funded us. The guy who I worked for 7, 8 years seed funded us, and he was a very prominent oil and gas guy who had created a lot of value for people, a lot of value. And so, yeah, so I think that that's a big reason that we were able to get backed.
Dude, that's awesome. So it's almost like it's a double-edged sword when it comes to raising capital, because I know that at least for us when we raised for the hotel, we have somebody on our team. His name's Neil. He's an absolutely like incredible hotelier, and his portfolio is
Is
insane
that
in
the
the
right word?
return.
It's hotelier.
Hotelier. Yeah, it's spelled hotelier, but it's hotelier.
I would
I'm
get.
pretty sure.
Can
I
I tell
could
you
be
something?
wrong, but that's how I've been
I
saying it.
would get into investing in hotels just for that.
Is that all?
That's
That's
a
all I needed
great
to do when
title.
I was pitching you was just
That's a
call you. You could
great
have been
title.
you could have been a hotelier. That would have
Hotelier.
changed everything.
Yeah, sorry, I did not mean to interrupt, but that's
No, you're totally good.
that's a
You're totally good. So yeah, he has like the return profile on some of his deals are most of his deals actually. So he's done 11 hotels over the last 11 years, and 8 of them he's doubled the value of the properties within a couple years. And the other ones that he hasn't, he like just bought a couple years ago. So he's like still on track too. I think he averaged doubling, not a couple years, a few years, so about 3 years. And he like just closed on the last couple, including ours. So his track record's like insane, but he's based in Arizona. So when we were moving over to California and talking to a lot of the private equity or a lot of it was like private lending more so than private equity. So it's just like it's pretty similar but slightly different. Um, we were talking to them and showing them the track record, but they didn't know the individual name.
Oh,
And
yeah.
so we still did really well with pitching them and
Right.
stuff like that. But I can imagine it would have been significantly easier if we were buying a hotel in the area and the market that he was in because of all the relationships
Yeah,
that he
for
already
sure.
had. It would have
Oh,
been more of a
for
like
sure.
the business plan and the pitch would have been more of a formality than anything else.
100%. Yeah, look, there is no doubt that having a strong network is really important in I think any industry, but for sure our industry. The other thing I would say is you can obviously go raise capital from a private equity in the energy space without a lot of connections or that kind of backing with a really great idea. Your just idea has to outweigh and trump whatever it is that that private equity has to kind of get over in order to invest in it. Because the reality is like, the way I kind of look at it, and I'm not a private equity guy, I've dealt with a lot of them obviously, but what I've learned more and more is what they are realizing is execution risk is really high in our industry. Building a team and actually going and executing is it's a pretty daunting task and it's not an easy thing to do. And so private equity is like when they have a team that they really like, or you have a track record of doing really well on the execution side, like they'll lean in on that because they view it as that's just as much risk as the whatever you're buying or the strategy
Right.
itself, because there's so many ways to mess it up. I mean, short of the market, like, I mean, like we tell you, you're spending millions of dollars and, doing a very technical thing, drilling a well in the ground. There's a lot of things that could go wrong. And so having a team that can do that and do it on time, on budget, I don't want to say it's rare, but it is something that private equities really desire. And so connections, track record, all those things play, which we did not have a track record, by the way. We had a team that could kind of show, hey, I've done this here and there, but we as a team did not have a track record. It was the first time going out, the first time we raised private equity. So that does matter. But I 100% agree. Like those things matter. Like a name, like a name can go a very long way. Like it really
Yeah.
can. We talk about it now, even buying deals. Like if you know the right person, whether it's you get a last look, whether it's, hey, you get a call from whoever it is saying, all the bids came in and you need to be at this number. All those things are relationship driven and they matter greatly, especially with how competitive our business is.
Dude, that makes a lot of sense. Yeah, that's wild. So when it comes to execution, like what are those variables that are the most difficult to nail down? Like where do most people slip up where you have to keep your eye on it?
Think cost. So the way I describe what we do is we build a $10 million house in 30 days. We're effectively a general contractor and we've got 120 vendors or subcontractors, if you will, that are out on a location drilling a well that costs $10 million. I mean, you can imagine how easy it is for cost overruns to happen, for things to go awry. And so that's one of them. I think the other is underwriting because the way that you underwrite a deal for us in a really really dubbed down version is you are making a guess on cost. You can get pretty close if you're good at it, right? Because you have guys that know how much it costs to drill these wells and know how to what we call AFE a well. You're making a guess on how much oil is going to come out of the ground and how fast it's going to come out of the ground. So it's not just how much, but when is it all going to come out, right? So if it takes a really long time, you're gonna have a really low IRR. If it comes out quicker, you're gonna have higher IRR. So you're making a guess at that. We call them type curves, right? And so those two are very large variables that can take you from a 60% rate of return well to losing money. Those are the two, most controllable things that you have. But then you also have commodity, right? So you're selling at a certain price, this oil at a certain price. You can't predict it. You can hedge it, but you can't predict it. So you don't know if it's going to go up or down or where it's going to go. And so that's part of your underwriting. And so all of these pieces, the cost to maintain the well after you drilled it. So all of those pieces, I think are when I think about like the toughest things to identify is all of those pieces and then hitting all those pieces, right?
What's the average range of a healthy IRR? Like when you're looking and you're doing your underwriting, which is basically analyzing a deal.
That's a good question. It's a good question because it really depends on kind of where you are in the state of the business, right? So starting off, you want a really healthy IRR because you're using all equity to do it. So you have a high cost of capital. And then you innately are going to learn things along the way, right? So if it's your first well out of the gate, there are things that you're going to mess up, whether it's estimating a cost or whatever it is. So you want very healthy IRRs, like 60, like you want to be looking at the piece of paper and saying our base case is like a 60%
Oh, wow.
IRR, 50, 60%, because you want to look at that and go, I'm going to miss, I'm going to screw up somewhere, probably. And where is that going to land me? Right. So once you're in the business and you're very predictive about it, I would say anything 20% and above. But the key though is you're picking a commodity price that you're underwriting all this at too, right? Which is a tricky part of our business.
Right.
Because that can change your IR pretty dramatically. If you have a really conservative underwriting who's like, we're going to put a $65 flat price on it. And you're like, well, it's trading at 79. Like, well, that's a dramatic change, right?
Right.
If I'm selling oil at 79 versus 65, that's makes all the difference in a world when I'm, producing, whatever it is, 30,000 barrels, 25,000 barrels in the first month or whatever it is. So what we look at it is we use flat pricing normally. And then what we like to see is if you're doing everything out of cash flow, we like to see something above a 20% rate of return or IRR.
Okay. That makes sense. So take us back to your story. So you built up a company. That was the first iteration. Then the second iteration, you raised 80 mil. You deployed about 100 mil. You said, right? Or did you raise the full 100?
On a gross basis. Well, on a net basis, actually, we probably put about 100 million to work. The first company, just so we're very clear, was not a good merge case. You were there for it. So yes, we built up the company, but we hit 2020. The company got merged. It was not a fun merger. It was a kind of a forced merger, if you will. And yeah, it was tough. Went through that, closed that literally December 31st of 2020. Yeah, spent that year trying to start the new one. We started the new company in January of 2022. And we'd found an asset because at the time, private equities were not backing teams. They would only back you if you had a reason to be backed. And we had found an asset, and so they wanted we were able to get backing because we found an asset. We're able to kind of get it to the finish line, and that's why they gave us. That's why they backed us.
What's that window of time like? So let's say you find an asset, I assume you get it under
Oh
contract,
my gosh.
and then you take that to private equity. Like how long can you hold an asset under contract while you're trying to raise capital? Like what does that
Well,
timeline look like?
that all depends. You don't really hold them under contract.
Oh, interesting.
No.
So it's more
Yeah.
like you find the deal and then take it to private equity and you're like, hey, somebody else could snag this.
Oh, for
What's to
sure.
keep them from just reaching out
So,
to a great team that they have on the sidelines
or they
to
will. They might. Yeah. Nothing. That's the right answer, Gideon. Nothing. No, I mean, so there's ways to do it. Like what we see a lot of these days is we see a lot of someone will bring a deal to a private equity And the private equity will say, hey, we'll pay some of your deal costs for exclusivity. And if we get it, great. If not, move on. And the private equity is like, we lost a little bit of money, but at the end of the day, like we didn't put all our eggs in one basket. See, private equity used to back teams. They called it getting G&A backed. And it was like, this is a rock star team. It's 3 or 4 guys, whatever it is. These guys are really good at what they do. And they would just say, we're going to pay you a full, overhead, or we call it G&A. We're going to pay you a full G&A for however long, give you a commitment, 50, 100, 200 million, whatever it is, and go find a deal. And so they used to do that all the time. They're coming back to it a little bit. Like some teams that have a really good track record, they'll do it too. But for the time period that we found this last deal, I mean, they weren't doing any of that. The only way you were getting a deal is with a private equity is if you had a deal to bring to the table.
Is
I
that because
mean,
it de-risks it significantly? Because you're like, look, this is
yeah,
like the team plus the deal, so I can actually show you like a more concrete return on your investment.
yeah. Well, because before, I mean, they would back. This happened to several teams. They'd back a team for 3 years and they'd never find anything. So they'd go burn. Let's say it's a $1.52 million G&A. So they're going to burn $6 million across 3 years with zilch. I mean, the
Wow.
only people that got paid were the team that got backed. But private equity at the time were so flush with funds and putting capital to work that they were okay with that. And, a lot of teams found deals, right? Because our first deal was G&A backed. We didn't have a deal. We got G&A backed, and we found a deal in a little bit less than a year. We got backed in like July, I think, of 2017 and closed on our first deal in like February or March of 2018. Yeah, so they're doing a little more of it now, a little bit more of it now, but they don't do much of it because for private equities to go raise funds, it's harder and harder.
What are some of the strings that are attached to private equity?
I mean, if you can think of a string, it's there. That's the way I describe it. Really, really though. I mean, and think of it this way: like we've put whatever it is, 100 plus million to work, like 95% plus of that capital. So they have all the control in the world. Some guys that have done really well have come in and they, you know, there's a few groups we know of where they've done, 3, 4 iterations of this, built up company, sold it, built up company, sold, built up company, sold it, to the point that the guys who started have made so much money that they are able to go raise private equity and own 51% of the business. And you can have a lot more control there. But yeah, the strings attached are you're, I mean, you essentially work for them. Now we're very fortunate. We have a great private equity. We really do. I really do think highly of, which, you know, it's a tough business. They let us run the business. I mean, like anything else, we have board meetings and we have, I talk to them weekly and, things like that. But generally speaking, they let us run the business. They want us to put what we think, and, you know, they, they believe in what we're doing, and our team's done great. We have a killer team, super smart guys that have crushed operations. So we built a lot of rapport with them too, where they
Right.
trust us, right? Yeah, it's tough. Private equities, they're like, I mean, you're gonna, yeah, yeah. It's tough. It can be a tough business too. There's a reason that people, if they don't have to do it, they don't want to
Right.
do it, right?
Right.
So energy is a little like I think the traditional private equity where they come in and just like scrape businesses to nothing and just, I think energy, it's a little bit different because they really do have to work in tandem. Like they have to put capital, they're not buying businesses, they're buying kind of teams and assets.
Right.
So they need the team to run the asset and they need the asset to work versus I think some traditional private equities where they go in and buy
And they just
80% of the business.
bundle it up.
They just, yeah,
Yeah.
they know what they're going in there to do.
Right.
So you hear those horror stories and I always think in my head, I always feel bad, but I always think in my head, I'm like, if you're selling out to them, you know what you're selling out to.
Right.
And like, that's your payday.
It's not like unexpected, like they're
Yeah.
pulling a fast one on you. It's
Yeah.
like this is what they
Yeah.
do and how they do
Yeah.
it.
And I've talked to some friends in other industries who've called me and said, "Hey, we've got this private equity talking to us, and what do you think?" And I'm like, I think you should vet them for the next 6 months.
Mm.
They're like, they tell us they're not gonna change our business, and I was like, okay, well, I don't know what. Then what are they doing? They're
Right.
just giving you money? No, they've got something in mind, and you should try and figure
So
out what
do
it
they
is.
usually have advisors that are like former operators that they have that actually influence the deal, or is it more
That's a great
like
question.
academic where they're like, oh, in theory it should do
Finance.
this, so yeah.
Yeah, they're all finance guys.
Okay.
Yeah, they're all come from the. I always think private equity is really funny because they're very high powered, like high productive humans, like, and they're all very similar.
Mm,
So I always say that, and this isn't a knock on them, it's just the nature of it. Like a lot of private equities don't actually know how to run an operations company
mm,
because they don't deal with it. It's like they deal with a bunch of really high IQ MBAs, finance, very smart guys. And so they're really good at this sort of um, very top level.
like risk
Um,
management.
well, and just like productive. I mean, like just, and they get paid a lot to do it, right? But just very productive, very like, um, you know, uh, very smart, very productive humans. And running an operations company, you have a whole slew that you're dealing with. It's not just, you've got landmen and accountants and operations guys and engineers and finance guys and all across the board. You're dealing with field guys. And so running an operations company is much more dynamic from a just managing people and managing a business versus at that level, they're really good at putting that business into an Excel sheet and telling you what they should do. It's why when you predict the business really well, they're really happy with you and they think everybody should do that. But I think what you would find is if you put them in the position to go predict the business, they go, "Oh wow, this is harder than I thought," because you have a bunch of humans. It's not
Right.
you can't just put numbers in and just assume that's what's going to come spit out at the end of it. Like I said, it's private equities. They're there for a reason. They're tough, um, but look, they can provide a lot of opportunity too, and you know that's why we're here. So
Yeah. I have a question. You said something earlier on. You mentioned that with, I think it was with the first iteration. The first time you do something, you need to underwrite to a higher IRR because I think you mentioned in your instance it was mostly equity, so the cost of capital is higher. Does that change over time where like you start raising debt for future deals?
for sure.
Okay, so what does that progression look like?
Yeah, so it's like anything. You have to have collateral to do whatever it is you're doing. So, to raise equity or debt. So, when equity comes into the business, it depends on what you're buying, right? So, if you're buying something that's already has production coming off of it, meaning cash flow, and you're selling oil, you can bring debt to the table right out of the gate, just like you would um, a real estate. Real estate's a little bit different, but you can bring debt to the table because um, you have cash flow, you have something that you can put that is producing that you can uh, use as collateral, right? If you don't, meaning you're buying a leasehold with no wells on it and you're going to go drill wells, then it's more of an iterative process, right? So as you drill wells and you bring wells online, you start producing oil and selling it and basically generating cash flow, then you can layer debt on as you go. So that's kind of generally speaking how it is. So if you buy an asset out of the gate that let's say it's got a production value, which we call PDP, PV, whatever it is, 10% return, 15% return. So if you've got a deal that's got $100 million worth of PDP, PV 10, we'll say, then I can go, if I'm going to go buy that, I can go to the bank and say, hey, I want to borrow 50, 60, whatever they will kind of give you. And their metrics are all based on concentration, price deck, all kinds of things. But I'm going to go borrow 50, $60 million to buy that deal. And then the other 40, 50% will be equity. And then as I drill wells and grow production, my debt load comes up and I can use cash flow or debt. The way we try to do is we kind of front load with equity, right? And then as we get the business going, we use debt and cash flow to kind of develop as we go out.
Nice.
So you're not continuing to pull equity. And then eventually the idea is you fold over, right? And then you're paying the equity a distribution, and then you get into waterfalls and all kinds of stuff.
Do you ever buy out the equity with debt?
Yeah, so you don't really there are instances where you can, but no, not really.
Okay.
And really the way that our business works, where people really normally the way they make their money is on an exit. So they go build up a business and they sell it.
So it'll just sell so would you like semantically call it selling all the iterations, or do the iterations build off of each other and you sell like a portfolio or something? Well, like what do you call that?
The most traditional model is you build up and you sell, and then you basically starting back over, build up, sell, build up, sell.
And who do you sell to? Is it just like you sell to the bigger fish in the
Yeah,
pond, and then
that's
that
right.
fish bundles it up
That's
and
right.
sells to the bigger fish in the
right.
pond?
That's right. So the like traditional, I say traditional, the way that private equity was when I like first got into it was unconventional. So all the shale drilling was happening. And so what guys would do is they would go out and they would accumulate acreage where they thought oil was, and they would poke 2 or 3 holes in the ground, right? And they would prove that there was oil there. And then they would go sell to a guy who was going to come to actually develop it. And they would make a big multiple on it because they would say, hey, I've bought all this acreage for, I don't know, I'm going to make this up, but I bought all this acreage for $10 million. And I drilled 3 wells, and each of them were $10 million. So I got $40 million in the business. And all four of those wells I drilled, or all 3 of those wells I drilled, right, have X amount of oil. So I'm selling to you, I'm selling another 50 of those wells. And because all those, and you as the buyer are looking at it going, man, I can make $1 million or $2 million a well. So I'm going to buy, 100 million. I'm going to pay $1 million for each one of those wells that I can go drill because I can make, $2-3 million on them. And then you had production with it. And so I'm going to go, I'm going to buy it for $100 million. And then you just 2x that in a couple of years. So that's the way it used to be. It's a little more difficult now because there's less land to just go grab. And so now you have to be more thoughtful about how you're building up a business. But yeah, the idea is you go in, you put pieces together and put all this stuff together, and then you drill wells and you get production up, and you create a package where a bigger company goes, he did all the dirty work. I'm going to take it and I'm just going to go
So
punch out my little
who's at the top? Like
Exxon.
you have, is that it? You just like,
Yeah.
because you do all this exploration, you get all these pads, then you bundle them up, sell to the next dog.
Yeah.
Then they bundle those up and sell
Yeah.
to the next dog, and it's just Exxon sitting on the top of this mountain.
Yeah, I mean, look, all the big ones. It's the Shells, the Exxons, the Chevrons, the EOGs, there's a lot of them, right?
So is the name of the game, if you want to go big, to eventually step up in those tiers? It's like you bundle
You
up a
go
bunch of
public, because that's
pads.
another way to exit is you go public, right? You build up a business big enough to where instead of selling to the big dog, you
Sell
IPO.
to the public. Yeah.
Yeah, it's another way to do it. And then there's a distribution model, which we've seen some people do. It's just harder to do because of the way our business is structured, which is you just drill wells and you're distributing cash back. And eventually you kind of get to a point where it's like owning shares in a public company that has a distribution. You just run a business. So we've seen that before. And private equities normally will exit at some point because you can do a financial exit too, right? So if I go buy a deal, right, and I buy it to go drill a bunch of wells, and those wells are 30 to 40% rate of return wells, and I go drill all these things, I could go sell to a either an institution or maybe even a big family office that will come buy all that production for a PV10. So I mean, I drilled these things at 40% rate of return, sold them at a 10% rate of return. So I made the spread, and I might still operate it, but the private equity's out, and this new owner owns the production, and they just clip their return on it. So
Gotcha. That makes sense.
yeah.
If you were going to enter this space with no money, no connections, how would you do
I don't know that I could. I think I could do something else. No, man, that's a great question. I mean, I was in an interesting spot because I wasn't kind of technical. I mean, the first thing I would do is I would build my connection. I would build a network. Because the reality of it is, and this is for me personally, right? I mean, I think that you can be really, that's the cool thing about oil and gas is you can span like some of the most brilliant engineers all the way to just deal guys, right? Or just guys that are well connected and know how to put people together. And so, and candidly, I fit more on that end. And so, like, part of the reason we were able to put this together um, is just, being with, having a good network and being very persistent and, understanding the business well enough to to understand and navigate what to and what not to do. But yeah, I mean, I think the first thing I would do is I would go try to build a network. And I think I'd do that in any business I got into. Um, I've realized it's kind of I think it's the best way to kind of deals it is, at least for me. And I know really technically savvy guys who they don't need to know anybody. They just know how to underwrite a deal, and they call up and they say, I want to buy this from you. And they give them a number, and that's it. I just, so for me, if I were starting off in our industry, I think I would build a network is the first thing I would try to do. Yeah, no money, I don't know. You gotta have money.
it?
You can't drill wells with no money. So,
Leverage the network to raise
yeah,
the
you would have to
capital.
leverage the network to go raise the capital. But yeah, I mean, I think, there are some really I mean, like I said, it's a really, really cool industry. A lot of really savvy people in our industry, who understand all aspects of it. And there's, the people in our industry run the gamut. I mean, it's what yeah, like, and I guess this is like most industries. I don't know, and maybe I'm a little bit biased, but the span by which you have in our industry with like all the way down to being in the field, like working with the guys that are actually turning the valves, all the way up to, you know, I mean, there are like a lot of guys in our industry, especially in the private equity side, where we were like, hey, y'all should come down to, they've been in the industry for 10, 15 years, never been to a well site. Like they don't even know what the rigs look like.
Right.
And so like the gambit that it runs, and they're close to it. It's not a guy in New York who just happens to have a lot of money. They're like they've been in this industry for 10 years as a private equity guy, directly funding on calls with like management teams, with guys that are drilling these wells. And they've never been there. They wouldn't know what a rig looks like if you drove by one. And so it's really cool to see the gambit of people that kind of exist in our industry, and all the way down to the very blue collar turning the valves. Some of the not some of the hardest workers we have are the guys that are in the field doing this stuff. It's insane. You think you have a hard job, and it's like, my goodness, like, and we go see these guys, and it's like, this is absurd. All the way up to, really, really, really brilliant, tech guys. So,
Yeah.
um,
Dude, I actually it was between my junior and senior year in college. I was an intern for
I
fracking
remember.
company.
Yeah.
Yeah, and I was a
Yeah.
field
That's
engineer.
who we use.
Yeah, really?
Yeah.
Oh, wow.
Yeah.
Yeah,
The
I was a
last couple wells we've had have been, we've used Frac Tech.
Yeah. No, it was a wild internship. The hours were bonkers because I was a mechanical engineer in
Yeah.
college with a minor in
Yeah. I
business
remember.
and energy. So I was a field engineer, but like nobody would respect you unless you actually got out there and swung the
Yeah.
hammer.
Yeah. Oh,
And
yeah.
so it was dirty
Did
and
you have to wear
messy.
the green hat, or that's on the
Yeah.
rig? Or did you wear one?
Yeah, I was a green hat.
Yeah.
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 And like 18 20-hour days sometimes.
Oh, it's absurd.
Dude, there were times I would go crash at my hotel for literally a few hours
Yeah.
and then get up again and go out and like fall asleep on the drive out there or fall asleep on site. The work is insane.
It
But I will say that was like, as somebody in there, what was I, 21, making that money. And I was on the hourly rate also. So it's like my hourly rate was way bigger than I'd ever seen because I was engineering, but field engineer.
Yeah.
But then also getting paid hourly and working the most preposterous hours.
Yeah.
I was working like 100, 120 hours a week.
Yeah.
And yeah, absolutely kicked my butt for 3 months
yeah.
straight. And then afterwards, of course, being 21, felt like the richest human on planet Earth.
Oh,
I
yeah.
was like,
Oh, yeah.
dude, literally, it was probably just like $20,000, 30,000, but I was like, I made it. This is it. And then I ended up not even doing that at all.
The amount of millionaires that oil and gas industry has made, from landowners to whatever, is crazy.
It's wild.
It is crazy. And you're right. And what's crazier is when you start taking into account like South Texas heat. And like it's insane
Yeah.
what these guys go do on a, 5 o'clock in the afternoon, have been out on a rig, yeah, it's insane. It's a crazy industry from that regard.
It's wild.
Yeah. And we took some guys out there not too long ago, and we walked them out there, and like some P guys, and they were like, because you build these little towns for like 30 days. I mean,
Yeah.
there's bunks there. I mean, there's full trailers with living quarters, guys that are on half the day, off half the day, back and forth. I mean, it's a little town on this pad, and it will be there for 30 days, and then they pack it all up and they're gone within 2 days. And you look there and you got a wellhead, and they, so it's crazy
Yeah.
industry.
So what is a question you feel people should be asking themselves to be successful in the space, but they don't?
I think if I had to ask a question, it would be character driven more than anything, technical. Because like anytime, and this by doing entrepreneurial things, it's tough. I mean, it's very hard. And especially when you build a team with people and you convince people to come do something with you, because you feel a little bit more responsible than just like, by yourself. So I don't really know what the question exactly would be, but I think that I think it would be character driven, and I think it would just be, probably ask myself like, are you ready to kind of go through the gauntlet? Something,
Dude, I love that. We haven't gotten that yet. Are you ready?
yeah. I mean, really though, like, yeah, this is something you're willing to kind of really
Just get
approach
punched in the face for
Yeah.
over and over.
Yeah. Yeah. I mean, look, this business is like, and it doesn't matter what it is, like any business, the moment you take like another step where you're like, oh, heck yeah, like something's going to hit you in the face. You just got to kind of keep doing it. And there's a lot of great things about it. I'm not trying to trash it. There are a lot of great things about it, but it's tough. It's for sure tough. You have to have
Oh, grit is the name of the game.
Yeah.
For sure. Grit is the name of the game.
Yeah.
All right, second question, and this is the one we're going to wrap up with. What is an instance where you've plateaued in your business and then you had an aha moment that enabled you to break through? Or even just an aha. It doesn't necessarily need to be for a plateau, but the plateaus for people who like they're looking for that breakthrough.
Yeah. I've probably had a few of them in my career. One of them was recognizing the importance of like a team, recognizing that there's a big difference between people who say they can do it versus people who can actually do it. Recognizing that is not necessarily easy, but when you have it, it's huge. And so I've learned to spend a lot of my time when we're hiring or when we're partnering with someone, really vetting to understand the person on the other end of that transaction. And so one of the aha moments, the people in your businesses, hiring is the hardest thing that you will do. And managing people is one of the hardest things you'll do, but the right people make your life 10 times easier. It's game changer when you have a great group of people around you. So, so that's been definitely something that is something I'm still learning today, but it's definitely something that it's been like, just because the guy has a great resume does not mean
Right.
a whole lot. Because I've hired people with killer resumes, and you're like, man, this person, I can't get them to, whatever.
Right.
And I've hired people that I'm like, I don't know about this guy, but my gut tells me to hire him, and I'm like, man, this guy's incredible. So yeah. In fact, most of the people I've hired, I've had major questions about for whatever reason
Oh,
that I've really
interesting.
ended up have been rock stars. Most of those people I had major reservations about. But
Interesting.
through getting to know them and through spending time with them, I was like, okay, I think this is a good fit, and it worked out. So
That's awesome. Solid. Well, Elliott, thank you so much for being on the
yeah.
show. I always love our chats, but this is definitely one for the books.